Welcome, welcome, everybody. Thank you so much for joining me this evening. If you are here to learn how you can use your retirement account to invest in real estate, you are in the right place. If that's not why you're here, thanks for stopping by anyway. You're going to learn about that. So, we're going to jump right into it. I know there's still some people hopping on and joining us, but we'll go on into the introductions. So, look, I just want to be respectful of your time. It's your evening, and I appreciate you so much for being here. So, I'm going to just start with the disclaimer that we have to get out of the way, right? So, I am not a CPA, I am not an attorney, I am not a tax advisor, financial advisor, or anything of that sort. I am a capital allocator and I invest in real estate for a living using my own retirement account, using other forms as well. And so, I'm just sharing my knowledge with you guys. So, you should always consult professionals if you're deciding to invest in something like that. So, with that disclaimer out of the way, you will not need to take frantic notes unless you really want to. I can send you these slides. So if you want the slides, you can just text IRA to the number that is on your screen, and I will shoot those slides over to you. And that way you can have them for future reference. I will be taking questions at the end. This is live. So by all means, jot those down as you're going so you don't forget. And then you'll have the opportunity to throw those in the comment section later. And I'll try to address as many questions as I can in the time we have allotted. And I'll also give you my contact information if you have questions beyond that. So do grab a pen and paper to write down any questions you have so you don't forget them. But don't worry about writing down everything on the slides because, like I said, you can have a copy of them just by texting this number. All right. So who am I? Let me, first of all, move this to a slightly bigger screen so you can see this a little bit better. So a little bit about who I am. I told you what I'm not. I'm not a CPA, attorney, all those kinds of things. So my actual job title is a capital allocator. If you don't know what that means, it basically means that I invest in real estate and then I spend a lot of time vetting deals, right? So I know a lot of different sponsors that have lots of different real estate investment opportunities throughout the country. So I spend months and months and months looking at those all year long and then picking a select few that I want to invest my own money into. I then invite others to invest alongside me in those deals. And jointly, we pool our money and we write a larger check into that investment. And when we do that, we typically get higher returns than if you invest on your own. So that's kind of what I do. And, the what's in it for me part of the equation, right? It means I make more on my own investments by teaming up with other people. So that's what I do. I do have personal real estate as well. That's kind of how I learned about all this. I've been in real estate for over 25 years. I have both single family homes as well as apartment complexes. But I also really like, in addition to doing active management, I really like doing passive investing in what are called real estate syndications. If you're not familiar with real estate syndications, all that is when lots of people come together, pool their money to buy something bigger than they might be able to buy if they were just buying it on their own. So that's kind of what syndication is. And you can do that very passively, which allows you to scale much faster because you don't have to manage everything your own, excuse me, on your own like you do if you're buying it yourself. So we'll talk a little bit more about what passive investing is. I'm also a business owner. My husband and I, we own 2 Massage Envy clinics. If you're familiar with Massage Envy, we own 2 of those here in Florida, one in Orlando and one in West Melbourne. If you happen to be from Florida, you might know where those places are. And so what we do is we take the cash flow from those businesses and we invest it in real estate. That really helps us with our taxes. It helps us have a second source of income should the businesses fail or just not do as well one quarter over another. So it just kind of keeps that going and sets us up nicely for retirement. I do invest in every property that I invite others to invest in. There are other people that are just sourcing money for their own deals. So they just have that one product with their own thing to do. I'm sourcing it from lots of different places because it's not just my money, but I'm sourcing it to put my money in first. There are also people who capital raise for other people's deals that don't necessarily invest in those deals alongside you. Nothing wrong with that. It's just a different model. I do offer direct investments as well as investments through funds. So what that means is some deals that you invest in, whether you invest just directly in that deal or if you combine your money with another group of people to get that higher level of a bigger check essentially into the deal won't make a difference. Sometimes the returns they give you are the same either way, in which case it isn't worth my time to put together a fund. But if we're going to get much higher returns because we're writing $1 million+ check, then I'll put together a fund so we can submit one large check. So I do both. I currently hold investments in 6 different states plus Puerto Rico. And that's kind of the beauty of this passive investing is you don't have to invest in your backyard. You can kind of invest anywhere you want because you've got a team there that's doing all the work. And Puerto Rico I invested in. I actually invested in a hotel down there because you just have amazing tax benefits over there. And so I'm all about it's not what you make, it's what you keep. So saving on taxes is a big part of that. And then I'm also a busy mom of 2 boys. And, if you've been in real estate for any length of time, or you know people who are, they're always talking about their why. Why do they do this? Why do they put themselves through all this? Same with business owners and that kind of stuff. There's usually a big why in the background. And my boys are my big why. So my oldest son, he has autism. Not sure what his future holds. So I want to make sure we are building legacy wealth to pass down to him. And also I don't want him to become a burden on my other son, right? So thanks for the thumbs up, whoever just did that. Thank you, appreciate that. So that's my big why. All right, so why invest in commercial real estate with your retirement accounts? There are lots of things that you can actually invest with in your retirement account. Some people don't even know that you can do anything outside of the stock market or mutual funds with it. So we'll talk about that. But why is this so attractive? Why are more and more people turning to this option? So in order to understand that, first we need to know what is commercial real estate. So it's not a single family home, a duplex, a triplex, or even a quadplex. Those are all considered residential real estate. In order to get into the commercial realm, you have to be 5 units or more if you're talking about a place where people live. So even though a quadruplex is a residential place and an apartment complex with 200 units is also residential, once you trip 5 units, that is considered commercial real estate. So that's when they are eligible for commercial type of loan products and all sorts of other things that go along with commercial real estate. But apartment complexes is not the only thing you can invest in the commercial real estate section. It is one of the most popular because everybody kind of needs a place to live. So there's a constant demand for it. But self-storage facilities are also very popular because you're not dealing with tenants, you're dealing with boxes. And you don't have long-term leases, so you could theoretically raise the rents every month if you wanted to. I don't know many places that would stay in business if they did that, but you have more flexibility. Mobile home parks, RV parks, also very popular because here you're really just investing in land. Usually the people who are living there own their own mobile home or RV. You're just leasing out the land. So it's a little less labor intensive. Same issues with, you don't have to deal with tenants and that kind of stuff. Retail centers used to be very popular. COVID hurt some of that. There are still some that do very well. Hotels, I'm invested in a hotel. There's also hotel to apartment conversions that people can invest in. I've done that as well. Office and medical buildings. Offices, again, took a hit during COVID, but medical buildings continued to go strong. So those are another option. Restaurants, I myself have never invested in restaurants, but there are people who do. So all those kinds of things and similar things are considered commercial real estate. And those are all things that you could potentially invest in your retirement account. So let's talk about some of the benefits of doing that versus other types of real estate. We're going to kind of just stay in the real estate world here. I know that you may be investing in some other things, but steady cash flow. That's something a lot of people look for, especially when they get into retirement. If you are investing in your retirement account now, but you won't be drawing on it for many, many years, you may not care about steady cash flow right now. So there are deals that produce cash flow, there are deals that produce no cash flow, and there are deals that do a little bit of both. So an example, one that would not do anything is if you are investing in new construction. So let's say you are investing in a self-storage facility that's being built. Okay, so while it's just trees or after they level, it's dirt, whatever, all that, there's no cash flow. Really, the cash flow doesn't come until it's fully built and leased out. And some companies, all they do is build it and then they sell it. So you make no money during the build out, might be 3-4 years to get that thing up and going, right? And then once it's stabilized, they sell it immediately and you just get a big fat check in the end. That might be great for your retirement account. But if you're already retired and you need income to live off of, probably not your best bet. So that's where you might need some steady cash flow. Then you might be better off in an apartment complex that's collecting rents and distributing that on a monthly or quarterly basis. So that's one appeal. Low risk of high economic or physical vacancy, especially in MF, which is multifamily. That's the apartment complexes. So if you were to invest in just a single family home, for example, so let's say you had $50,000. Okay, you could put $50,000 down on a house and buy that, or you could put $50,000 into a 100-unit apartment complex and buy that and become an owner. Either way, you still get tax benefits, all that kind of stuff. But with the house, when you have a tenant in there, you have 100% occupancy, 0% vacancy. But if they move out in the middle of the night, now you've dropped to 0% occupancy, right? So you go from 100 to 0. And you could end up with economic vacancy, meaning they're there, but they're not paying any rent, and you're dealing with a long eviction or something like that. So there's some risk there. In an apartment complex, it's very unlikely that all 100 tenants are all going to move out at one time, right? There's always some vacancy, right? There's never 100% or very rarely so, but you don't have this chance of all of a sudden I have no money to pay the mortgage. So that's one of the benefits. Tax benefits. So depending on the type of retirement account you use, whether it's an IRA or 401k, investors can enjoy either tax-deferred or tax-free growth. A lot of that comes into play, whether it's a traditional account or a Roth account, and we'll get more into that. But this allows for investments to compound over time without immediate tax liabilities, which can be very powerful. So again, I'm all about how much you keep, not necessarily how much you make, but the combination of that, right? So we want to do that. Completely passive. It can be completely passive if you do commercial real estate. If you are on the passive investor side, there are people that choose to be on the active side, and I'll show you kind of what those mean. But in your retirement accounts, your only option really is to be passive. So you can do that where you don't have to deal with the tenants and the toilets and the termites and all that kind of stuff. High return on investment due to economies of scale. So this is basically anything where you're dealing with huge economies of scale, you get better deals, right? Just like going to Costco versus going to your regular grocery store. You're buying in bulk, everything is in bulk, you get better prices. So same if you are buying a single family home, again, you decided to go that route, the refrigerator breaks, you got to buy one new refrigerator. You're probably going to go to Lowe's or Home Depot, someplace like that, and you're going to buy that refrigerator at regular retail cost. If I'm buying a 100-unit apartment complex, and we're going to be renovating all those units, and we're buying 100 refrigerators, we're probably going direct to the manufacturer to get those. So we're going to get them much bigger, much better deals. Same with replacing a roof or anything like that. Your price per square footage and repairing those is going to be much, much lower. So overall, you end up with just the economies of scale. You can have in-house management, and you can have your own repair people and all that kind of stuff. So everything just gets cheaper and therefore more profitable in the end. Less susceptibility to market volatility than stocks. We're seeing this right now. If you are in the stock market, you've probably been watching your accounts go up and down all over the place, particularly now that it's election time coming up. We're going to see that volatility increase a lot more. So when you're retired, you might not want that volatility, or you may not ever want that volatility. So you may just want to diversify and put some of your portfolio into real estate where you have more of a slow and steady kind of thing. Inflation hedge. Boy, have we seen this in the last few years. Have you seen the price of houses just going through the roof? The price of everything went through the roof. Cost of employees, cost of everything you buy on a daily basis, and rents, of course, went up. And so when all that happens, the price of real estate goes up. And so your money that you have invested in that is worth more now, right? So it's a great hedge against inflation. When also the other thing about commercial real estate is, unlike residential homes, your value is not based on the properties around you, right? It's not really this comparison that you get when you want to know the value of your house. They do comps, right? They look at other things. When it comes to commercial real estate, it's really all based on the income that property is producing. So you've got a little more control there, like how well it's being run and what you're doing to keep your tenants happy. That's going to make a difference. But as rates for rent go up, which they do in inflation, right? Inflationary periods, everything goes up. That includes rents. The property value goes up with it because that equation is in your favor there. Okay. We'll get into that a little bit more later. Diversification, we already talked about that a little bit. You can diversify out of stocks into real estate. You can also diversify into different markets. Just like I purchased in 6 different states so far, right? I'm looking for markets that are growing quickly with large demands on real estate. I'm looking for places that are landlord friendly, more so than tenant friendly. You know, I've got certain markets that I like, but I don't have to live in all those markets to buy there because it is passive. So I've got that possibility. I can also diversify into lots of different asset classes. I can have some self-storage, I can have some retail areas, some medical offices, some apartment complexes, all mixed together because I don't have to know absolutely everything there is to know about that particular asset class because there's a professional team in place that's doing that, and I'm just a passive investor. But I am an owner, right? So I still get the owner benefits. Minimum management hassle, that kind of goes along with it. Scalability. You can really scale with this because you're not adding to your workload as you're taking on more investments. As an active investor, if you're doing all the stuff, there's only so much you can do, right? I used to have a larger rental portfolio of single family homes, and it started to drive me a little bonkers, to tell you the truth, right? So I started selling them off and going a little more passive to where I could scale and have more and more real estate without adding to my workload. Long-term appreciation, everybody knows how real estate just goes up in value over time. You look at what the price of things were 10 years ago, 20 years ago, you can see what they might be 10 or 20 years from now. That is that long-term appreciation. But in commercial real estate, you also get forced appreciation. And we're going to dive into this a little bit deeper because this is one of the things I really, really love about commercial real estate. Talked about more control over the value of the property. So there is this equation, and we're going to talk about it here on this next slide, where the value is based on the finances, again, not on the appraisals, right? So if you increase the value, either by increasing the revenue or by decreasing expenses, you can directly affect the value of that property. So let me give you some examples. Let's say there were no washer dryers in the apartment when you bought this apartment complex. If you add a washer dryer to an apartment complex, that usually increases the rent by about $50 a month. Okay. If they didn't allow pets and now you decide I'm going to allow pets, you might be able to charge $25 extra a month in pet rent. You may also be able to charge some pet fees or pet deposits. Maybe you add covered parking and you give your tenants an option to park under the covered parking for an extra whatever it is per month, right? So you can have all this additional income that you could bring in. Some people get very creative about this. Valet trash is a thing now. That was never a thing when I lived in apartments, right? But if you're too lazy to take your trash to the garbage, you can pay someone to pick it up at your door and they will put it in the dumpster for you, and people will pay for that. There's also lots of ways to decrease expenses. You could renegotiate your landscaping contracts, for example, or you could switch to LED lighting or low flow toilets or anything that is affecting your common areas where you're paying the utility bills, add solar power, all sorts of things. So anything that can change that equation is going to be in your benefit. So you see the equation here, just a $50 increase in income. So that can be revenue increased or expenses decreased, right? But makes a $50 bump. That could just be that washer and dryer we discussed, right? And then you have 100 units in this apartment complex and 12 months in a year. That's going to add about, I think that's $60,000. Yeah, $60,000 of income, just that little bit, because again, we've got that big scale. You divide it by the area cap rate. So every market has cap rates in particular areas, and the local brokers know what these cap rates are, but it's kind of a steady part that tells you how much you should be getting for your money in those markets. It's kind of hard to explain what a cap rate is, but basically every area will have a sort of a set cap rate depending on the market at the particular time. But it's set for anything in the similar area where you're at. So let's say it's a 6 cap, that's sort of middle of the line. There are areas where there are 4 caps, there are areas where there are 8 caps. So we're shooting for 6 cap right smack in the middle. That little $50 bump changes the value of that property by $1 million. That's how easy it is. So that's what's called forced appreciation. You can wait for natural appreciation, or you can force it in some areas by adding more value to the property. So that's called a value add. That's very common. Okay. How can you use your retirement accounts to purchase real estate? All right, let's really deep into it. So the key to this is to have a self-directed account. And some people, including myself, had never heard of this, didn't know there was such a thing as a self-directed account. But sure enough, they are available, and this is what you need to do if you want to invest in real estate. So they can be IRAs or they can be 401ks, right? And that allows you to diversify into a lot of different investments than the traditional accounts normally could. So it could be real estate, could be private equity, could be precious metals. If you want to go buy gold bars and stick them under your mattress, you can do that. You can even do cryptocurrency if you want, and all sorts of other alternative investments. So you can get a much more diversified portfolio than just being in the stock market. Okay. There are some rules that go along with self-directed accounts. First of all, there are certain things that are prohibited. All right. You cannot engage in self-dealing. What this basically is don't invest with your family members, right? So investing in assets that benefit you or other disqualified persons, and these disqualified persons, for the most part, are family members, right? So you can't do that. You also can't buy things for your personal use, right? So let's say you're investing in a yacht company, I don't know, but you're just out on that yacht all the time, or you buy a short-term rental at your favorite ski resort so you can go stay there. Okay. IRS does not like that. So you can certainly buy a short-term rental as part of your self-directed account, but it needs to be for business purposes to create revenue for you, not for you to go stay there while you go skiing. Disqualified investments. There are a few things they do not allow you to invest in. Collectibles is one of those. It can be very hard to value these things. And yes, alcoholic beverages are considered collectibles. So I think they're talking about like the really expensive wine collections that some people have and that sort of thing. So you cannot invest in those. You cannot invest in life insurance policies. So those are a couple things that you can't invest in. There is some compliance, and the most important here is a custodian requirement. So there needs to be a third party between you and the IRS to make sure everything is done legitimately and that all the reporting that needs to happen is taken care of. So you do have to find a custodian to do this for you. So they will set up your account. And then when you want to do something, you want to go buy something, you tell your custodian, you direct them to go buy this, that, or the other thing. And then when the money comes in from those investments, it goes back into the account. The custodian registers it into your retirement account. So there are contribution limits. They are the same as in your accounts normally. So you do have to still follow those. You don't get out of those. There are still required minimum distributions when you hit age 72 for most of the accounts. I believe Roth IRAs have an exception to that. And I believe if you're in a Roth solo 401k, when you reach 72, you can roll it into the IRA if you wish to avoid that. But do check with your CPA on that. Again, I am not a CPA. So yeah, those rules do still apply, but there are ways to kind of get around some of that a little bit. Active management and involvement. While you can actively manage your self-directed retirement account by making investment decisions and directing your custodian to execute certain transactions, there are limitations on your involvement in the day-to-day operations of those assets. Okay. So in the real estate world, you cannot personally manage a rental property owned by your self-directed IRA. So think of it as, so you're not really the owner, you own the IRA, but the IRA owns the asset. And you cannot perform rent repairs, collect rents, handle tenant issues, any of that kind of stuff. Not that you want to anyway, but you would have to have a third-party manager to handle those kinds of things if you're buying, things of that nature. Business operations. You cannot run a business that your IRA or your self-directed 401k, either one, bought. Okay. Think about retirement. Okay. This is for retirement purposes. So you should not be running a business. You can passively invest in a company. You can own shares in a company as long as you're not actively participating in that. And back to the earlier rules, you can't be investing in a family member's business, right? Because you would trip that rule there. Improving properties. If you were to buy a fixer-upper of some sort, let's say you wanted to do a flip within your portfolio, which you could potentially do, but you have to go through a third-party person all the time while you're doing that, which may not be very profitable if you do that, but you could. But if there were repair needs, the IRA or the 401k would need to pay for all of that. You can't come out of your personal pocket to do that. You can't commingle those funds. So that's another important rule to know. Other than that, what is passive investing? That's kind of the idea, right? Like everything is about retirement. So think about being passive because you will eventually be retired when it comes to these funds. Even if you're just investing in it now and will be retiring later, you still have to think of it that way. So we've danced around this topic quite a bit, but basically active investing is when you acquire things on your own, you manage your renovations, you manage leasing and a manager potentially, you manage residence, maintenance, and it is limited by your time, your knowledge, and your resources. So we see this primarily in the single family home market, right? Passive investing is where the deals are presented to you. Okay, you don't have to go scurry around on MLS or wherever to find these deals. So there are deal sponsors that have deals in a contract that need investors. They can come to you, or you can come to someone like me who's a capital allocator where I have investments coming up and I can say, hey, I'm investing in this. Would you like to come along with me? And they can present you different ones and you can pick which ones you like and which ones you don't like. Then that team that's putting that together, they're in charge of doing all the renovations, the leasing, the managing of the tenants, all that kind of stuff. So yeah, that gives you the ability to partner on some bigger deals where you may not have the knowledge to take something like that on your own. So that's more common in that commercial real estate realm that we've been talking about. So that doesn't mean you don't have anything that you need to do as a passive investor. There are a few things that you must still do. So first of all, you have to pick an asset class. You have to decide what you want to invest in. Multifamily like apartment complexes, retail, any of those other things that we've talked about. So those are called asset classes, and you would pick one of those. And you need to define your goals. Are you investing for cash flow because you need this money to live on because you're in that retirement phase of your life? Or are you investing more for equity where you want to grow that wealth to a much higher level before you retire? So you have it to pull from then. And there are some properties that do a little bit of both, but generally there's a lean for one side or the other. So I've seen cash flow plays where they're paying you like 10% on your money. They pay you out every month, very high cash flow, but there's no upside in the end, right? You're not getting an equity chunk at the end of that as well. And then there's others where we talked about specifically like with new construction, where there's no cash flow because nobody's living there. They're still building it. And then they build it and they sell it immediately. So you just get a bunch of equity in the end. So those are all different things to consider. Do you have the liquidity to invest? So your self-directed account would need to have somewhere in the neighborhood of $50,000 to $100,000 to get into most of these deals. Yes, I've seen deals as low as 25,000, and I've seen some where the minimum investment is like 250,000. I've even seen $500,000. That's the minimum investment. But the vast majority are in this $50,000 to $100,000 range. And if you have a lot of money in there, I would suggest chunking it into smaller pieces. Don't put all your eggs in one basket. It's actually really fun to see how these properties do and to be diversified in different properties and get reports from all over and see how your apartments are doing. So I still recommend coming in at a lower level unless they have, sometimes you just get a little bit more higher returns if you invest a bigger chunk. Nothing wrong with that, but it's also nice to break it up a little bit. You need to find an operating partner, someone you trust that's going to take good care of these properties because, again, it's passive. You're not going to have any say in how things are managed on this property. So it's important that you trust the people you're investing with. You need to be sophisticated or an accredited investor. So there are basically two investments. To get technical, one's called a 506B, one's called a 506C. Those are just two different types of syndications, and they allow for different types of investors. One is not better than the other. They just have different requirements. So for 506B, anybody who's either sophisticated or an accredited investors can invest in them as long as they know the person offering the investment opportunity, right? So you have to have a personal relationship with that person. They have to know that you are going to be qualified to invest in this. You do have enough sophistication to understand what you're getting yourself into. Okay, so you start that by setting up a call with that capital allocator or the deal sponsor and getting to know them, right? So they have to know you. They have to, You have to be in their investor club. They usually have investor clubs. You have to have done some basic education to show that, yes, I understand what I'm getting into. So they don't get those calls, a year into the deal that's maybe supposed to be a 5-year hold and say, hey, I want my money out now. Well, that's not an option in some of these long-term hold properties, right? So you just have to have a true understanding of what you're investing in, which you should always have anything you're investing into. I invested in crypto, didn't know a thing about it, lost a bunch of money, right? So don't do what I did. So that's kind of what sophisticated means. It just means that you understand what you're investing in. 506Cs, that's the other group of classifications for syndications. Those you do not have to, those are for accredited investors only. Okay. So those you don't have to prove that you know everything. You don't have to, not everything, you don't have to know everything. You don't have to prove your knowledge base, and you do not have to have a personal relationship with the person offering it. So if you saw an ad for something you wanted to invest in that was on Facebook or Instagram or something, and you want to invest in that and you're an accredited investor, you are allowed to. So the difference is those 506Cs can be advertised to anybody. You don't have to have that personal relationship, but you have to be accredited. So what does it mean to be accredited? Accredited just means that you meet either a net worth criteria or an income criteria. You do not have to meet both. It's one or the other. So for the net worth, it is if you have a net worth of $1 million or more, not counting your personal residence. Okay. So if you had money in your retirement account, your savings account, stocks, if you had an investment property, if you had a business that had some value, your cars, RVs, anything you own, basically, if all that totals up to $1 million or more, again, excluding your personal residence, then you are automatically an accredited investor. You just need to get a letter from your CPA that says that. The other way you qualify is to have an income of $200,000 or more per year, or if you're filing jointly with a spouse, it's $300,000 a year. And you have to have reasonable expectations that that will continue for the next 2 years. So if you meet either of those, then you're an accredited investor, and you could invest in a 506C or a 506B. Versus sophisticated investors, they can only invest in 506Bs. Those are offered to you directly through a investor club because you've set up some sort of personal relationship with that deal sponsor, and they're bringing you deals and they know you. So that's kind of the difference there. You do need to learn to analyze the deals. You don't have to know how to calculate all the income streams and expenses and all that kind of stuff, but you do need to know some of the basic terminology and understand when someone presents you with a business plan or pitch deck or offering memorandum. There are lots of different terms, right? Understand what they're going for here. What is the entry point? What's the exit point? How much can you anticipate making? How realistic is it that those projected returns are going to turn into real returns, right? So you just need to be able to look at those. That is not hard to learn to do. There's tons of free resources on this. There's YouTube videos, there's podcasts, there's books. I have all of those resources on my website at bluevikingscapital.com. They're all free. And there's a bunch of other people that offer the same thing. So that's not hard information to get your hands on. Okay, let's look at some of the different assets. So there's risks and rewards to all investments, right? There's no such thing as a completely risk-free investment. So there are risks in all of them. We're just going to look at two of my favorites. And that, of course, is apartment complexes. I've been talking about that quite a lot. But economic downturns can impact your residence, right? So we saw again in COVID, a lot of people were not working, had trouble paying rents, had problems like that, right? It can be a very competitive market. We're seeing less of that competition now, but there are some areas where they overbuilt in areas, right? So that can be competitive. And there can be property management challenges. I take that back. There are always property management challenges, but they're not yours to deal with if you're investing passively. But you do need to make sure there's a team in place that is equipped to handle those kinds of things, because it's never perfectly smooth sailing. The rewards are you can have that stable cash flow. You can have the economies of scale, the appreciation that we talked about, the depreciation, which we'll talk about in a minute. And there's usually a lot of demand for apartment complexes. We're seeing that right now more so than ever. Not only does everybody need a place to live, but it's harder now. to get into single family homes. The prices have become unaffordable for so many people. My young sons may never be able to afford their own house because the housing prices have just outpaced the income that people are making by such great folds. And I realize the cost of rents have also gone up, but not nearly as much as purchasing a home. So the demand is much higher right now. So depreciation, that is the paper loss that you get on any kind of real estate. So you can write that off your taxes. Now, if you are investing in your retirement account, you can't actually take that because you're already either deferring your taxes or you're not paying taxes because it was paid in advance on your Roth. So you can't take advantage of it there, but a lot of my investors, they invest both within their retirement accounts and outside of the retirement account. If they're investing outside of it, you do get depreciation on these large properties. And here's the kicker here. So one of the properties we just closed on, it was a $34 million property. The bank brought almost 70% of that, right? So the investors only bring in 30%. But the depreciation is on the entire value of the property. So all the owners get a share of that depreciation for the full value, despite the fact that a lot of the money comes from the bank. So that's one of the beautiful things when you get into these really big scales, if you're investing outside of your rental portfolio, your retirement account. Sorry about that. So just a little note on that. Okay. Let's talk about one of my other favorite things to invest in. So this is more of a cash flow play. If you private lending, it's really hot right now. A lot of people use private lenders if they're doing fix and flips, for example. They're just needing short-term loans, 6 to 9 months. It's really not worth it for them to go to a bank. To get a loan from a bank can take months. A lot of times they're buying these properties because they're distressed and they need to close really quickly. So they go to private lenders and they'll pay a lot higher interest than they will in the bank, but they don't care because they're only holding that loan for, like I said, 6 to 9 months, maybe 12 months at most. But then they're reselling it, right? So it's not like when you get a 30-year mortgage where you're going to be a lot more concerned about those things. So you can do that within your self-directed retirement account. You can invest in private lending. You can either do directly if you know people who need those types of loans, you can set that up, or you can go to somebody who's sort of intermediary, like a matchmaker that says, hey, person A needs money, person B has money, you guys get together, do these loans. Or what I like to do, Blue Vikings Capital has a fund where we do this on a large scale, and you can invest in the fund. You get a set return every month. 7 to 10% is what that one pays out, right? Depending on how much you deposit there. And you just get a monthly check for that. And we lend that money out. And it's not tied directly to one property. It's diversified across the entire fund. And you don't have to find a new person to lend to every 6, 9, or 12 months when that loan is done, right? Because it just stays in the fund. So lots of ways to invest private lending. And that's just a cash flow play. There is no equity upside on that, right? But if there are foreclosures, you're in a first lien position, you take the property, resell it. Again, if you're a fund, you don't have to worry about that. But there's no particular tax benefits here, like the depreciation that we talked about before. But again, if you're investing in your retirement account, you can't take that depreciation anyway, so it doesn't really affect you there. But it is a stable cash flow play. You can do compounding interest in there as well. And the nice thing is it's a little more liquid than if you're investing in a long-term hold on one of these apartment complexes. They usually hold anywhere from 3 to 7 years. That's kind of average. But in these things, because they're short-term loans, you can get your money back faster if you need to. So it's a great place to have the rainy money day funds, right? When you don't want to put them in a bank where you're getting far less return on your money. Okay, so let's look at the typical structure of a passive investment deal. So when someone's going to buy one of these properties, regardless of the type of asset it is, they form a new LLC. And there are two classes of ownership in there. You have your GPs, your general partners, and you have your LPs, your limited partners. So the general partners, those are the people operating it. They're the operational partners. They're the ones who found the deal, got it under contract, and they're going to do all the work. Then you have your passive investors. They are just providing money for the difference between what the bank is bringing and the purchase price, including closing costs, maybe renovation costs, all that kind of stuff. So they're just money. They're kind of the silent partners that don't have to do anything. So that's kind of what that looks like. But all of them are owners. They all share and all the ownership values of this property. The passive investors, they are just again providing the capital. They usually get either monthly or quarterly distributions depending on um, and that's assuming this is cash flowing property, right? And then they get equity upside when the property sells. The operating partners, they might get some fees along the way, but most of the money they make is going to be again at the sale there. So the onus is on them to get the value of that property up so they can get that big paycheck at the end of this whole period. All right, let's look at a couple of properties for this. So here's some examples of some passive investment opportunities that I've offered members of my Blue Vikings Investor Club within the last year here. So you can see that they're different sizes. You know, you got 94 units up to almost 300 units here. They're in different parts of the country. We've got Ohio, we got Texas, we got Florida, all markets that are growing, have strong demand for rental properties, and have very tenant or landlord friendly laws in place. Really, that's kind of what I like to look at. I like sort of the nicer units, but not brand new units. So things built in the 80s, 90s, or early teens, where you can go in and renovate and make these properties look brand new and gorgeous, but you're not buying the brand new product, which is going to be far more expensive and not cash flow quite as well for you, right? Or you won't have that value add. So I like to be there. They're usually class B plus, A minus is what we call these kinds of assets. If you have a downturn in the economy, people who are living in these very luxurious brand new apartments might not be able to afford to stay there. They might bump down to this asset class or this apartment class. People in the opposite, if the economy is really booming, you might have people who are living in less fancy apartments move up to this stage, right? So it's kind of in the middle. So it works in both markets. So this is kind of what I go for. They're, different people have different ideas of what to invest in, but this is what I like. So how much can these properties pay out? So this is what the Portofino property that we just closed on was. The average cash on cash was projected here to be 8.3%. So what that means is we're looking at the cash flow component, right? The rental revenues. You get all the rents and other incomes that come in every year. You pay out all the expenses, your mortgage, your landscaping, your property management fees, all of that. And of course, all the loan costs. And then what's left over, that's your cash flow, and that gets split amongst the investors. So on average here, that would be 8.3% per year. So that doesn't mean that every year you get an 8.3%. It usually grows with time. Usually right when these are purchased, there's, so many costs associated with getting into one of these properties, and they have to do that value add play to get the rents to go up. So maybe the first year it's only at 4%, and then maybe it goes up to 6%. And then at the end of the whole period, maybe it's up to 12 or 14%. But on average, when you average it out over the whole period, 8.3% on this particular property. The AAR, this is the average annualized return. And the difference here is now you're factoring in all the money you get when the property resells. So the goal with most of these properties is to double your money in 4 to 6 years. At least the properties that I'm looking for. That's what I'm looking for. So here they're going to accomplish that and then go over that a little bit. And so the average, when you look at all your returns, including that big money at the end, is 26%. Again, that does not mean you're getting 26% every year. You're going to get that smaller, basically the cash on cash for most of the time until the very end where you're going to get like 100 something percent, right? And you're averaging that out. So that's what that means. So these are some of those terms you need to get familiar with that you get in some of this education. IRR is another component. So this is basically the same thing as your average annualized return, but now you're taking into account the time value of money. So it's the internal rate of return. And it's kind of hard to calculate. There's spreadsheets for doing this. But basically what this does is it looks at when you get your money back. Because the sooner you get your money back, the more valuable it is to you. So a good example of this is I give you $1, and then you immediately give me $2 back. I just doubled my money instantly. Wow, that's really great. My IRR on that is really high. But if I give you $1 today and 20 years from now you give me $2 back, I'm a lot less exciting because my dollar might not even be worth those $2 might not even be worth what $1 is worth today, right? So that's not the same value. So that's what an IRR calculation is. So 20%, that's really high. It's very good. I like that deal. Okay. And then you have your equity multiple. So, what an equity multiple is basically that's for every dollar I put in, how many am I getting out? Right. So, in this case, a 2.3 equity multiple means I'm going to put $1 in. For every $1 I put in, I'm going to get out $2.30. So, that's just overall on the deal. So, again, this matters with what is the time frame? How long does it take you to get that in? So, an equity multiple of this in a few years is wonderful. If it takes 20, 30 years, not so great. So you're looking at what it is time frame was. The minimum investment on this particular deal was $50,000 and the maximum investment on it was $2 million. And it was a 5-year hold. So it just gives you a little look into how apartment complexes might be. This, I'd say this is probably higher than average. This is pretty high end. So we brought a lot of money to this deal. It was $2.75 million. So we wrote a rather large check. So we got really great returns on that. So typical might be a little bit less than this, but this is certainly attainable. Okay. Steps to creating a self-directed account. So if passive investing interests you, then these are the steps to set up that self-directed account that we talked about. So step number 1 is to find a custodian. So I mentioned you have to have that custodian between you and the IRS. They are not hard to find. You can literally just Google custodian of retirement account in my area. There are several companies that can do this. If you need some suggestions, I'm happy to suggest a few. But there are things that you should consider with them. So there are fees and costs for them to set up the account for you. They may charge fees to do your actual investments on your behalf. So here it might matter what you're going to be investing in. If you're doing private lending on your own, where you are setting up deals all the time to send out money to folks and they're charging per transaction, that might not be so great. If you're doing one investment and you're going to hold that for 5 years, then that probably doesn't matter, right? So think about your investment strategy when you're looking at their fees. Some may just have an annual fee that covers whatever you need to do, right? So just look at those kinds of things. Make sure they're familiar with the types of investments you want to do so they don't start asking you a bunch of questions. Oh, what do you mean you want to invest in gold bars? I don't know anything about that. So make sure that they're lined up with that. And I really want to stress customer service and how important that is. A lot of these investments, when they come up, the time frame for getting into them is very short. If you don't get your money in there in that given time frame before the deadlines, you're going to miss that opportunity. They always have a waiting list. So you will get bumped to someone on the waiting list if it takes a long time to get your money into that deal. And especially if you're doing private lending, in those cases, those usually have a short time turnaround. They need to get their money in and out. So can't be waiting on your custodian to drag their feet. So that's important. All right. Types of accounts. All right. We talked about self-directed IRAs called SDIRAs. They can either be a traditional IRA or a Roth, and we'll talk about the pros and cons of both of those. And then you can have a solo 401k. So if you are self-employed, or if you own a small business that just employs you and or your spouse, you can set up a solo 401k, and those are really powerful. So if you have the ability to do that, I highly recommend that. So those are the two. So you would select that, and then you would have to open the account and fund the account. And people kind of misconstrue these, okay? So you do have to open a new account, even if you have a current IRA or 401k, and you're planning on funding your new account by rolling those over into them. So that's the funding aspect. You have to set up the account first. Some people just start filling out those rollover paperwork, and they think their current account converts to the self-directed. That's not what happens. You have to actually create the account and move the funds into it. So don't miss that step of opening the account first. But then you can just start funding it like you normally would, especially 401k. It's your business. You're starting to pull money out of that, putting it into here. You can do that. IRA, you're just taking the money out of your job and putting it in there. You can do that. But if you do have previous IRAs or 401ks, you can roll them over if you own the account. What does that mean, owning the account? Well, if you are currently employed by somebody and they offer a 401k or an IRA, they probably own that account. Okay. It's not yours until you leave their employment. But if you had a previous employer, you don't work for them anymore, and they had a 401k, you are now the owner of that. You can roll that into your new account. Okay. Hopefully that makes sense. If not, hit me up in the questions section. All right. So let's dive a little bit deeper into these types of accounts. So what does it mean to be a traditional versus a Roth? So traditional, that's how IRAs kind of started, is that they had this tax deferred thing. So they sold it to you this way. They said, hey, we can take this money out before taxes come out of your paycheck, and we'll put it into this account. And then when you withdraw it, when you retire, you pay the taxes then. And this will be good because you'll be in a lower tax bracket then. All right. There's some problems with this. First of all, I don't intend to make less money later in my life. I intend to be making more. Okay. If that's your plan, then you'll be in a higher tax bracket later. Also, governments tend to change tax brackets. And when they do, they tend to not go down, they tend to go up. So you may still end up in a higher tax bracket later. And maybe now you're on a fixed income and you can't afford to be paying more taxes later. Okay. And then it also kind of is based on the idea that you're not going to be investing that money very well. And so there's not going to be that much money to pay taxes on in there. But if you're doing this kind of stuff and you're doubling your money every 4 to 6 years, you could be building a tremendous amount of wealth in that account. And now when you start pulling it out, you're going to start paying a lot of taxes. So traditional is not always the way to go. You might wish to go Roth. And what Roth does is you pay the taxes up front at whatever your current income bracket is, tax bracket is. You pay the taxes now, and then the money that you make in that Roth account is tax free. That wealth can just continue to double, do whatever you want in there, and it will all be tax free when you pull it out. So that's how I lean for the most part. Don't worry if you have a traditional and you want to switch to a Roth, you can roll it over, but you do take the tax hit. Thank you for the thumbs up there. Yeah, so you're not stuck in it, but if you do roll it, just be aware that you will have that tax consequence when you roll a traditional into a Roth. You'll have to pay that immediately, but you can do that in pieces. You don't have to roll it all together all at once. All right, so that's Roth versus traditional. They exist both in IRAs as well as in 401ks. Within the IRAs, there is a contribution limit of $7,000 a year. That doesn't count your rollovers. If you're over the age of 50, it goes up to $8,000 a year. Okay, so now let's take a look at your 401ks and how that differs. So again, this is if you're self-employed or if you have a small business and it's just you or you and your spouse. Once again, they can be either traditional or Roth, but they allow for a higher contribution. So here you can contribute up to $69,000 a year. How powerful is that? If you could put that much in there every year, if you're over the age of 80, it goes up to 76.5. And in addition to the higher contribution limits, they also include loan provisions where even before you're retired, you can borrow money essentially from yourself. And if you're paying interest on it, you're paying it back to yourself. So it's kind of like getting a free loan. So if you ever got in trouble, so you're like putting as much as you can in there, but then you're like, oh, I put a little too much. You can actually borrow it back if you needed to. So that's a really nice thing. And the way they do that, the reason the limits are so much higher is because you can contribute both as the employee and as the employer. And being self-employed, it's all just you, right? But yeah, you can contribute both as yourself and as the employer. So that's how you get to these higher limits. I'm not going to get into all the details of that. All right, there are some common mistakes that happen here. We're actually running a little short on time, so I'm going to skip over this, but I do have this in my ultimate guide to using your retirement accounts for investing in real estate. Some of you already have it. It's how you found me, is you probably have this, but if not, you can scan this QR code and that will get you that. I'm going to see if I can also put it in the comments. Okay, I just put the link in the comments there. So if you are on live with us on the streaming networks, you might not see it, but if you're on here, you can get that. And if you use the link there, then you don't even have to put in your email address or anything like that. Okay, so hopefully you got that. And if not, like I said, it's in the comments there. So real quick, let's talk about the steps to get started here. So if this appeals to you, you need to first, of course, set up that self-directed retirement account if you don't already have one. Then you need to find a capital allocator like Blue Vikings Capital or a deal sponsor to invest with. You want to schedule a discovery and qualifications call, right? This is where we talk about what your goals for investing are, what you've invested in before, how knowledgeable you are about this. If there's some education lacking, I could help you get those kinds of things. This is not a sales pitch, okay? There's no investments being offered on these calls, and there's no cost to these calls, all right? Speaking with me or anyone like me is always free. So don't hesitate to set up those calls. Then you want to join their investor club. That is how you get notified of upcoming investments. And I don't recommend investing in the first thing you see. So I even provide a bunch of samples on my website of past deals, so you can start looking through previous deals to see what interests you, so that when one comes along that you like, you already know how to recognize it. You don't want to jump in the first thing until you've really done some research on these kinds of things, because a lot of them are long-term commitments. Not all of them, but most are. So you want to have that discovery call, make sure you understand what interests you, what doesn't, and then that capital allocator can sort of call you when they find something that fits your buy box, if that's what you want them to do. But you want to join those investor clubs. If you join an investor club and you haven't done the discovery call, you'll usually get an email or text that says, hey, you need to set up this qualification call, right? But yeah, anyway, we won't get into all that. Education research, like I said, it's everywhere. Podcasts, books, webinars like this all count towards your education. And then you need to be ready to move quickly when the deal that you like comes about. Most of these investor clubs, they have hundreds, if not thousands, of members in them. And when these deals come out, sometimes they can only take 10 investors. Maybe on a larger one, might be able to take 30 or 40 investors. But those spots can fill up really, really quickly. So you need to know how to recognize a good deal when you see one. And that comes from kind of doing some of this homework in advance, right? So far we have learned why commercial real estate might be a good fit for you, how you can use your retirement account to invest, what passive investing is, and the types of investment options that are out there. We've looked at some case studies and some sample returns, and we've covered the steps to create your self-directed account and the steps to get started. So that's pretty much all there is to it. This is what the Blue Vikings capital investing process looks like if you chose to go with us. We do the preliminary calls and we get you qualified, right? We look to see if you're accredited or non-accredited, so we can send you the right types of deals. And then once you're accepted, you can be in that investor club. You can get those deals when they come out. When you get them, you review them. And then if you have questions, you just set up another call with us, right? You just say, Maria, I need to talk about this deal. I don't understand some of this terminology, or tell me a little bit more about this team that's doing this, or about this business plan, and we'll hash those out. Then if you like the deal, you make what's called a soft commitment. That basically just puts you on the list of the people who are interested in investing and holds your place. Once you do that, then you get the legal document. So you get to read through all the legalese and make sure you're comfortable with this. You are not fully committed until you sign those legal documents and actually wire in your money. Until then, it's still a soft commitment. So there's really no harm in getting on that list and holding your place, because you could still back out at that point, and then it'll bump to somebody who's on the waiting list. But that's kind of the order of operations here. You're not going to get all the legal documents until you make a soft commitment. And then, congratulations, you are an apartment complex owner or self-storage owner, whatever it is that you chose to invest in. And then you'll start getting updates on how your property is doing, and you can find all of the regular reports in your investor portal. So that's kind of what the process looks like if you were to go down that road. Again, if you didn't see this earlier, if you came in late and you want the slides, just text IRA to the phone number that's on your screen, and you will get all of those slides. And I will also send out this recording to anybody who wants it, for anybody who signed up. So you'll get the recording as well. If you want to join my investor club, that says please set up a call with me, but it will get you on our list to see what investment opportunities are out there. So if you want to start screening those, you can absolutely do that. I'll leave this up for just another second, and then we're going to go to our Q&A here. So thank you all for sticking with me. All right. If you want to connect with me on social media, you're welcome to do that as well. I've got my whole link tree on here, so you can choose the social media of your choice. I also have a lot of free resources on my website, which is right there for you. So remember, I'm a capital allocator, so I work for the investors. I do not work for deal sponsors. So I'm far less biased than someone who's trying to close their own deal, right? I'm vetting opportunities for my own money when investing in these properties, and then I invite others to invest alongside me. By pooling our money, we usually get higher returns than people investing directly into deal, or a lot of times we can. And then you also have me looking out for your interest because I usually negotiate a seat at the asset management table. Doesn't mean I get to manage the asset. It means I get to be in on their asset management calls and listen in and just see what's going on with those properties. And, I can maybe interject my 2 cents if I don't like what's going on, but at least I always have knowledge of what's happening there. So that's pretty much it. My services are free. So use me, use my knowledge, use my experience, and hit me with your questions. So with that, I'm going to open it up to any questions you might have. So feel free to put those in the comments section there. Happy to, like I said, answer anything you've got. If you are watching through Facebook or Instagram or one of those platforms, I don't know that your comments will come through because they have stopped allowing for some of these third-party comments to go in both directions. A lot of times you guys can see my comments, but I can't see yours. But if you follow the Eventbrite link or you got the StreamYard link that we emailed out, then I should be able to see your comments. So just go ahead and throw them in there and I will address those. And I know some of you may have more personal questions. Feel free to email those to me separately if you'd like, or set up a call with me to discuss your particular situation. But if there aren't any questions, I wish you a very good evening and I really appreciate your time. If there aren't any questions, I must have done a darn good job. I thought I covered that rather quickly and spoke too fast, but maybe not, maybe not. So, all right, I'll hang out for another 2-3 minutes. And if there's comments, if there are questions, I'll hang out as long as you want. But some of you may be typing. I did this same webinar twice today, actually. I did one at noon, and there was tons of questions. Okay, here's one. Okay. Oh, thank you. Great presentation. Thank you, Jess. I appreciate that. But yeah, so sometimes there are lots of questions during these things, and sometimes there are very few. You never know. Some people are just shy too. But there's no such thing as a stupid question. I covered a ton of information there. So, all right. If there aren't any questions, by all means, reach out to me personally if you have those, and have a wonderful evening. But I'll stay on here for 5 more minutes if something does come trickling in. So if you need to go, by all means, have a wonderful evening. And if not, like I said, I'm here for another 5 minutes or so.